Hello, everybody. This is Jose. How are you, everyone? Good to see you. We are about to get started. Just a few seconds, as always. Quick sound check. A quick message on the chat box will do. A quick hello. Always nice. And that will tell me that you hear me, so we are ready to get started. All should be okay. But again, always good to get this extra confirmation as we are getting ready to begin. So please go ahead and type a quick hello on the chat box when you have a moment. So I know we're good. Thank you so much. 15 seconds to go. And we will be on our way. Very good. Top of the hour. Fantastic. Thank you so much. Thank you, Joe. Everyone, welcome to the session. Today is July 21st, 2022. My name is Jose Blasco. This is Options Trading Live. We're going to be looking at the options markets, as the name of the session suggests. Planning trades, analyzing the markets. We will be looking at certain trades that we have running as well. So we will also talk about trade management and, of course, building new positions from scratch. Before we get started, I would like to highlight the financial disclaimer on the upper left side of the screen. Please read it carefully. This is important information. It is fairly short. Therefore, I'm counting on you all to read it completely. Thank you so much. Jeff, good to see you. Joanne, good to see you. Everyone. Mark, good to see you as well. Fantastic. Perfect. Okay, so the plan. We look at the markets. We look at reviewing trades, talk about trade management, and from there we look at new opportunities. Let's begin. And by the way, as we start, questions page. If you have any question, you can always come to tradewithufos.com/Jose. You scroll down to the bottom, and here you will find the questions and answers section. You can do searches for questions and find your answers. Or if you have a question that has not been answered yet, you can click on the green button, phrase your question, and we'll get back to you with those answers. Keep in mind that it would be good that you document your questions properly with screenshots of the charts and whatever is needed, since this particular forum allows you to upload pictures and things of that sort. So make sure you do that, so that way we understand better the question and we can help you better. And let me turn off the ticker in the bottom part of the screen. We don't need that anymore. So let's begin. Here we go. So let's begin with looking at the VIX. Okay, so we're gonna be looking at the VIX. So what's happening with the VIX? The VIX has been trading lower. The VIX is currently trading at 23. Okay, so again, if we go back in time, we are basically trading at the levels of June. Lesser than that will bring us back to April. Again, so the VIX in April was trading around 20. The top that we had up there was 30 plus. We are currently trading at 24. So we could say that the VIX is a little bit on the low side. Not that low, but certainly not high at all. Okay, not even average. So from that point of view, being a buyer of option would be a better choice overall. And that's great, because when looking at the S&P and looking at what is more intelligent to do from a statistical point of view, from a directional point of view, so I am glad to say it's taking a while. It's taking a long time actually, but I'm glad to say that we are in a confirmed climate to the upside, as implied volatility of the calls in blue color is above the implied volatility of the puts in gray color. So in other words, we have a market condition which is 2 out of 6. Okay, a bit careful there, because the max distance is 0.81 and we went to 115. So this move to the upside has been quite strong. So careful with that. But putting that little warning sign on the side, it is a market condition that meets our rules to be directional to the upside, to look for long opportunities. That's a long time ago. I was not saying that, isn't it? So we have it. Okay, notice how many thin dots, thin blue dots we got on the past. Everything has been thin dots all the way to April. Okay, so we are back to a condition which is now allowing us to go directional long. So after I'm done with doing the market review, this is the type of trade I'm going to look for. I'm going to look for opportunities to go long, and we'll see what the market has to offer. But that's the market environment. Okay, anyone has any comment around that? During the trading session, we can also see the options volume map showing us more activity on the call side and the put side, 1.4 times more calls than puts. Real-time implied volatility for the calls is also higher than the implied volatility for the puts. So again, there are buyers in the market as we speak, my friends. And it's all confirmed for us to plan on those trades to the long side. So let's begin the preparation of those trades right after we complete our review of positions that we have. So Verizon is a position that I'm just going to delete. This is a trade that expired in July 15, which was last Friday. We commented on this last week, so I'm just going to delete it. This trade ended up as a profit. I think it was $36 per contract. Delta Airlines is a trade that is also concluded. Expiration date for Delta Airlines was also July 15. So this trade ended up with a net P&L of negative 52. That was the end result, which is great because this trade didn't work in our favor at all. And we managed to cut down the risk all the way to $52 per contract, which is a great reduction of risk. So that was pretty cool. And then we are left with two trades that we have. So one of them being Twitter, which is the first trade that we're going to work on. And the second one being JD, which is an iron condor. The Twitter trade is a double calendar with expiration being July 29, which is next Friday. So let's take a look at what is it that we have with Twitter in our hands. Let me load Twitter and let's take a look at what is it that we have in our hands. Okay, so anyway, so Twitter is a double calendar using the 42 strikes as well as using the 37 strikes. Currently, the stock is trading at 39.70. So when you look at the P&L, at the risk graph, I mean to say, so we are in that portion where the trade is currently performing at a rate of minus $58 per contract. Okay. Now, of course, when we are reaching this stage in the expiration cycle, as we are getting closer to Thursday, Friday, sometimes Wednesdays, depending on the stock and the price movement of that stock. So it's time for us to look at the option chain, looking for anomalies on the Greeks, what we normally call distorted Greeks. Okay, so I'm looking at July 22 and July 29. I said that we are using the strike 37 and 42. So I'm just going to highlight those two guys on the option chain with a golden color background. Okay, and if we start with the call side, which is the 42. So when we look at the call side on the current expiration date, we have 9-10 cents of premium, where theta suggests 17 cents. So based on theta, we are supposed to make 17 cents times 2, which it's impossible, right? Because 17 cents times 2, that would be $34, and there is only 9 to 10 cents to decay. So the calls are distorted, and therefore we are gonna be planning on rolling them. Okay, now careful. If I take the 42 call that expires in July 22 and I roll it to become the 42 call that expires in July 29, so basically what I'm doing is I'm closing my long call, right? So remember, when we do double calendars, let me float this. Okay, when we do double calendars, okay, on the last week before expiration, the strike that we sell should not be 42, but 43. Okay, one strike above or one strike below. So instead of 42, we will substitute 42 and make it 43. So instead of a double calendar, it becomes a double diagonal. And then on the bottom part, we're going to do the same thing. Instead of the 37, we're going to do the 36. It's going to be one strike below 37. So instead of a double calendar, again, it becomes a double diagonal. We talked about that in multiple sessions in the past. If there is any question about it, please let me know on the chat box. I'm happy to repeat, rephrase, review, and all of the above. If it's clear, I'll just keep going. Okay, so I'll be monitoring the chat box to see if you need more support there in a moment. Okay, so again, going back to here, if you look at the 42 and the 43, and if we look at the 37 and the 36, okay, so what do we have? Okay, so why is it okay now? So we can see how the 43 call would provide 22 cents, okay, of credit, which is also indeed more than the 9 to 10 cents that are left. Okay, so it's time to go ahead and roll the call side. We're going to take this 42 call that expires tomorrow on the 22nd of July. We're going to roll it, create a rolling order. Okay, but very important, instead of 22 to 29, that's fine, but instead of 42 to 42, we're going to do 42 to 43. Okay, and this is going to add 9 cents of credit. It's not that much, but that's what it is, and we're just going to go ahead and do that. Okay, so confirm and send. Let's do it, and let's see if I get filled in a moment. Okay, so on the put side, same story. So we're going to be looking at the 37. We got 11 cents to 10 cents left. Theta is looking at 19. Okay, so 19 times 2, it's way more than 11 cents. So the Greeks are distorted. Therefore, we're going to be looking at selling the 36 put, which is currently trading at 25 cents. Okay, so very same thing when it comes to rolling. We're going to come to Twitter. We're going to look at the 37 put. We're going to create a rolling order. And we're going to make sure it goes from 22 to 29. This is correct. And it goes from 37 to 36. And again, this is adding 13 cents on the put side. So we're going to confirm and send, and see if we got filled. So I can update all that information on the risk graph, and you will see the resulting risk graph. Basically, we're going to move from a risk graph that looks like that, okay, to a risk graph where the maximum loss, which is this horizontal line, is going to be pushed up a little bit. Okay, how much? Well, if we're going to get $9 and $13, so let's call it 20 something. So this line is going to be pushed up by 20 something dollars. Okay, but also because it's going to be a double diagonal, then the double V shape here is going to be different. Okay, so let's go ahead and I'm just going to do. Actually, I got filled on one. I got filled on the call side. The put side not yet. So let's we got 9 cents. Okay, very good. So let's substitute this in here. So compare spreads, copy primary, edit. What we're doing is that we're moving everything to be 29. The put will become 36. The call will become 43. And we just got extra 9 cents, which is the same as saying that instead of 39, it's 48. Okay, so I got a little bit more premium. And I just got filled on the put side. I got 13 on the put side, just got filled. So this is the same as saying that instead of 127, I got 13, which is the same as 13 extra, which is the same as saying that I got 140. So if I click OK, now you can see how this trade has a different risk profile, which is a risk profile now where the worst case, would be to risk 86 instead of risking 108. So we have diminished the risk by those, let's call it $20. Okay, and so that's where that line now is higher than these lines by that amount. So we pushed it higher by that amount, the new credit collected. But the beauty is that because instead of a double diagonal, let me rephrase it, double calendar, we made it a double diagonal. So now if the stock goes either above 42 or below 36, now we are going to make a profit on this trade. Okay, we're going to make a profit. Now, the size of the profit, unfortunately, it's only 14. It's not a great profit. Why is that? Well, the reason why it's the case is because volatilities have not really increased, including the fact that Twitter is in the process of reporting earnings. The scare of volatility took place last week. I guess it was enough scare for the volatility to go up last week, meaning that it's not growing into earnings this week, because really what happened with Mr. Elon Musk last week is probably more scary than what the earnings are supposed to be for Twitter. So we are not getting the benefit of a great increase in implied volatility in this particular case. And therefore, best case for this trade will be to make a very tiny profit. So it's not going to be that amazing, but let's see what happens. Of course, if we had an extra addition of implied volatility, okay, so and we had not done the conversion, the current trade that we have still would pay more, as you can see. But again, that increase of volatility will need to happen before tomorrow, because after tomorrow, the blue line is over, right? So again, doing the conversion now that the Greeks are distorted is the way to do it. And basically, we are now asking Mr. Earnings to please push the prices either above 42.86 or below 36.14. If not, we're going to lose $86 per contract, and best case, we're going to make a bit more. Okay. Now, this is the normal approach to this trade. But I don't know you, I'm not too satisfied. Okay. So I'm going to try to tweak to make this better. Okay. And this one step I just done, it's the right step to do. So it's not like I need to undo anything I've done. I'm just saying that after doing what I've done, which is the right thing to do, again, in a normal case, if I had a greater increase in implied volatility approaching earnings, as we've seen many times, then that would be a much more profitable trade, and we are done with the trade, and we just do this, and that's it. We wait for the earnings and the expiration date. But because I didn't have enough push on implied volatility on this last week, I'm gonna try to tweak it even more. Okay, and by tweaking it even more, I may get an extra benefit or a better setup that will make this trade to be more adequate. Okay, so let's take a look and see if I can make this better. So let me copy this position to the clipboard first of all, and I closed the panel. Okay, got it. So let me go back to top. Positions. I'm going to paste what I just did to Twitter here. So it's there. And now that I have it here, I'm just going to open it again in a new risk graph. And so this is the trade that we have now. Okay. And I'm going to try to do something with it. So if you think about this trade, let me make some space here on the right, so you can see what is it that we have. Okay, so right now what we have is this. Okay, so we have let me do this. Okay, everything is July 29 now. So let me reword this just to make sure everybody follows what I'm gonna attempt. Paste. No, not that one. That was silly. Okay. Let's not be lazy. July 29. Okay, so we sold the 43 call, and we are long the 42 call. Okay, so this is what we have on the call side. Okay, so I will delete this one, Okay, this is what we have on the call side. And on the put side, what we have is also July 29. So we are long the 36 put, the 37 put, and we are short the 36 put. Okay, so this is what we have on the bottom part with the puts. Okay, so I believe this should be clear. Okay, so what am I going to try to do? Well, since this is not paying me enough, my attempt is going to be the following. I'm going to try using the same expiration date to buy a 44 call and sell another 43 call. So in other words, I'm going to try to convert the upper part by adding the 2 units on the right. Sell the 43 call, buy the 44 call. If I do that, it will be long the 44, short 2 of the 43, long one of the 44. By the way, bonus question, everybody. What kind of strategy is this? How do we call that strategy where you are long a unit below, you are short 2 units in the middle, and you are long another unit above? How do we call that type of strategy? Please type it on the chat box. And the same approach, I'm going to do it on the bottom side, which is I'm going to sell another 36 put, and then I'm going to buy below a 35 put. So if I was to do that, same story. It's a call butterfly, very good. It's a butterfly, Joe, fantastic, good one. So on the bottom part, now what's the name of the strategy of the one below? Okay, what's the name of the strategy of the one below? Right? I got 137 put, 2 of the 36 in the middle, and 1 of the 35 below. So it's the same as what I had above. Okay, it's the same as what I had above, but now I have it with the puts. So how do we call it? How do we call the one below? Right? That's the question. So while you answer, put butterfly. Very good, fantastic. You got it. So what am I doing now is, look, I converted the double calendar into a double diagonal, right? And now what I want to do is I want to convert it into a double butterfly. Okay, that's another evolution that goes beyond. Of course, now we're going to be dealing with 8 units, so it gets more, interesting. But we may achieve the desired result. Let's take a look. Okay, so what if I add? I'm going to start with the calls. So I'm going to add 2 legs. It's going to be call, mid. So what if I buy the 44 and sell another 43? Okay, so buy, sell 44, 43 calls, which is that. Okay, and what if 1 leg, 2 legs, put, okay, sell, buy. So what if I sell the 36 and I buy the 35? Okay, so again, sell, buy, 36, 35 put, which is exactly that. Okay, I'm adding this. If we do this, what's going to happen? Okay, click OK, and let's maximize this. So this is what's going to happen. Okay, and unfortunately it's not helping enough, so we're not going to do it, but you can see what I was trying to do here. Okay, you can see what I was trying to do, which is bringing the maximum risk, which now was 86, to a lesser risk, which I managed to make it 71. Now, the reason why I'm not too happy about this is because, my profit zone now becomes extremely small, and the profit, the perfect profit on that profit zone is just a little higher than that. It's $25. So it's not like I have improved the trade by a lot, and I need to do so many. I need to pay so many commissions for so many more units. So it's not helping that much. And also, it has a lot to do with the fact that Twitter is a $40 stock. So, of course, we talked about this many times in the past when we are dealing with stocks which are not very high price points. We benefit less from trading options compared to stocks which are pricier. Okay. We talked about this before, but anyway, at least you've got to see my attempt. Okay, managing options trades, doing the tweaks that we do often imply multiple attempts to see which one is the tweak that produces the most powerful improvement. In this case, I would say that the improvement is not that significant, where I am that impressed. Okay, so what is my last choice here? I can try something else. And again, this one is going to be just a little bit more advanced and probably a bit riskier. But if I was to benefit from some price anomalies, if some of the strikes, let's take a look at the skew on July 29. So if some of the strikes were to present some price anomaly on either the call or the put side, there is a big price anomaly there. But apart from that strike, the 44, which I'm using, everything else looks, kind of like, a book smile. So I'm not sure what I'm about to do is going to work, but we're going to try. Okay, so the next possibility here would be to create what is known as a broken wing butterfly, meaning that I'm gonna, instead of having the 44 strike I was using before, okay, I'm gonna have nothing there. Okay, I'm gonna have nothing there. So I'm moving my upper strike one above. By doing that, I may be increasing the risk of the trade, but also increasing the total amount of credit collected from both sides. And if I was to benefit from a little bit of price anomaly, given the fact I'm doing it in both sides, this may work better. Okay, let's try. So it would be 36.34. Okay, I'm moving the strike one below, 36.34. Just like here I did 43.45. I moved the strike one above, so now I'm doing one below. So let's do it. I'm gonna edit the spread, and instead of 35, I'll go for 34, and instead of 44, I'll go for 45. Correct. And if I do okay, so let's take a look at what is it that we've built. Yes, and no, not helping me. Not helping me. I'm actually increasing the risk. Okay, I went from this level to below. Okay, so again, didn't work. But basically, this you just saw me go through the various collection of possibilities when it comes to trying to massage the trade as much as possible. And it seems that really our one step, which is basically this risk profile, the one that we have done, it's the ideal tweak, where now the only thing we need is that we need Twitter to have a nice reaction to earnings, to give us a move, and either be above 42.86 or below 36.14, and then we'll be in a profit. If not, this trade will not be the best trade of the year. Okay, it will end up losing $86 per contract, and this is part of trading. Before I go and check JD, how is it going out there? Questions, comments? It was a bit advanced. I'm glad I got to go through this process. I don't think I've done this before, to convert the double calendar into double diagonal and then do something else on top of it. I don't think I've done it. It didn't work this time, but sometimes it's worth it. Again, often with stocks of a higher price point, it may help better. Okay, so I don't see. Yeah, Mark, I get you, my friend. We wish we could see the future, isn't it? Yes. Anyway, So next one, JD. So JD is an iron condor. We put it together last week. If I recall correctly, I believe I said that this was a little bit of a boring trade from a P&L point of view because the most that can be made was very limited. But because the risk was also very low, it was a very nice trade for practice purposes. And because it's a 1 week iron condor, often you get this extremely fast rate of time decay, and this was a very valid example for practice. Now, to make money with it like in a proper way, you will need to use so many contracts that I'm not a fan of trades with such a small risk because you need to use so many contracts. Okay, but again, that's just me. So now, what is happening here? Well, the trade is working exactly according to plan. We enter right here the other day. The stock went a little higher. It's currently trading at this price point, and the probability cone is pointing at this and this as where the limits, the theoretical limits where the stock should be tomorrow on expiration. Therefore, it looks like we're gonna end up in the purple area, and being in the purple area, it means this trade is profitable. So option number one, do nothing. Just let it expire and you're done. Okay. The risk graph is clearly showing that we are right here. We are currently making $19 per contract in this trade, where the maximum that can be made is 22. So it's really looking nice. It was an easy one. Really no need for management or anything. Simple. Okay. Now, having said that, another rule that I wanted to remind you that we discussed in the past, especially for these iron condors, which are a 1 week iron condor, is that I know some of you have a rule where when you do a trade of this sort, you close it for half of the credit. Okay, so half of the credit would be like when it got to 11 cents, maybe that was 2 or 3 days ago, you just close the trade and you're out. In my case, I don't like to do that because half of the credit would be less than my minimum. So my rule, the one I use, which I mentioned many times in the sessions, is that I like to get a minimum of 15% of raw risk. So how much is the raw risk? The raw risk is the distance between strikes, which is 1, and 15% of 1 is 15 cents. So I want to get at least 15 cents, right? So 11 cents, which is half of 22, would not be enough. It would not meet my rule. Okay, so one possibility could have been to place an order. Last week when we did the trade, we could have placed an order, okay, a closing order, GTC, okay, a GTC closing order, where if I bring a calculator, not that is really needed for this, but just to be visual. So we got 22 cents when we did the trade, and I just said my minimum is 15. So the difference is 7 cents. So as long as we close this trade at 7 cents, I'm gonna make my $15. Okay? So we could have placed an order like that, GTC, and then we would have got filled probably a couple of days ago or something like that, and we'd be out of the trade for $15 of profit, which was our minimum. Okay, I'm gonna execute it now, so we get filled, so you see it. But really, there's nothing else to talk about this trade because there was nothing to be done at all. That's it. We just got filled at 6 cents, so the trade is over. We made $16 on the trade. Congratulations, done. Okay. Again, that's the beauty of those 1 week iron condors. The downside, remember, is that if the stock goes against you, there is very little you can do to improve it because there is no premium left to improve anything because it's only 1 week. Okay, so that's the downside. But the beauty is that you may do that on Thursday, you get into Friday, you get into the weekend, maybe on Monday the stock didn't move too much, and that's it. You just got filled for your $15 of profit. So that's you don't even need to wait until today, which is Thursday next week. Okay, so that's the beauty. Even though if the stock moves against you, there is no option for management. So anyway, done with JD. Twitter is still running. We will review next week what was the end result for Twitter. And now it's time to look for a new trade. And we are going to load the matrix here so we can start our analysis. Okay. Now, today I'm not looking for neutral trades. Okay. I'm looking for directional trade. We said the S&P is in an up climate, which is confirmed. That was a long time we didn't have that. So let's begin our analysis. First thing I would like to find is stocks that provide options with a top positive CIV spread. So I want implied volatility of the calls to be greater than implied volatility of the puts. I would like stocks, and you're about to see me do something new. I would like stocks that belong to sectors which are strong up. Okay? And if I do this, I got nothing. Okay? That's why I said you're about to see me do something new. Why? Because is there something wrong? Is it wrong to go long? No, it's not wrong to go long. But the problem is that in a normal scenario where we are dealing with a bullish market environment, like it's been happening the whole last year, for example, so the majority of those sectors, or many of them, are blue. So certainly it makes a lot of sense to look for stocks that are in sectors that are strong. We talked about this before. Millions of times stocks are fragile by themselves, all of that. But what happens? The market has been dropping quite severely during this year 2022. So there is only one sector, telecommunications, which is bullish in the long term, right there. And if you get into that one, diversified services and wireless, those are groups where it's not like there are that many stocks. Look at that. It's only 5 stocks. So in other words, when we are looking for stocks that belong to groups that are strong to the upside, and on top of that, I'm adding the top positive CIV spread, that's a very big demand that basically give me no results. So I am okay in a market condition like now to be a bit more flexible, because given the fact that the S&P is turning around, what's going to happen is that just like we say stocks are fragile and they need supported by the sector, well, sectors are fragile and they need to be supported by the S&P. So because the S&P is now turning, we don't know yet who are going to be the strong sectors in the long term. Let's say 2 weeks, 1 month, 2 months from now. We don't know yet. So what I want to look for is I want to look for sectors that are rotating. So what is a rotation? A rotation is this. When it goes from below to above, okay? Below to above. This is flat, has not rotated yet. This was still above. This is a rotation. Okay, so those are sectors that are rotating. Because they're rotating, again, when we observe this again, a few days, a few weeks, a few months from now, we may see a lot of blue in those places, but it happens to be just the very, very beginning of the move. So in a market condition like now, where there is no stocks that belong to strong groups, the way for me to look for opportunities will be to look for rotations that happen anywhere in the last 5 days. So any sector that has rotated up in the last 5 days, okay, that has stocks in it with positive CIV spread, I'll be happy to explore the opportunities there. Now notice how the list is a longer list. Of course, talking about the list, if I add my penny increment options list, then of course that list is going to be shorter, but hopefully I have still a few, okay, which is the case. So now what do I have here? I got stocks where calls are winning the battle against the puts, which is bullish. I got stocks that belong to groups that have rotated in the last 5 days. So there may be some momentum to the upside in those groups, and therefore that may lead for the group to continue expanding to the upside. So the stock is supported by something. Please confirm that up to this point, the rationale behind the technicals I'm describing is making sense to you guys, because this is something new that I have not done before. Relying on rotation is something that in other market conditions is not needed. Also because when the market is very bullish or very bearish, nothing is rotating, because it's already rotated since it started going up or started going down. But now that things are changing direction, that's where we are now looking for rotations. Okay? And thank you so much, Joe. And we got the scan list, and we're going to be looking at earnings not to happen in the next let's try 30 days. The list may be a bit shorter, but it should be okay. Let's see. And then, of course, we would like the auto climate to be confirmed to the upside. Again, if I pick weekly upside and daily upside, I guess, it's going to be, if I go like that, I'm going to get nothing. I'd be shocked if I get something. Nothing. Why? Because it's the same. Since the market has been falling, there are extremely little stocks that are in a weekly up climate. Just like there are very little stocks that belong to sectors that are up. So therefore, I'm going to uncheck the weekly and rely exclusively on the daily. Okay, and when I do that, now I get a couple of symbols. Again, it'd be great to have those stocks to be close to the EMA, so to be a bit more flexible, I'm going to go for sensible instead of early. Okay, and now I got nothing. So nothing is close to the EMA, but with sensible, let's see what I got. I got those. Okay, so those are stocks that could be valid candidates. Okay, now what's the implied volatility in those particular stocks? So again, because they are so very little, I'm just gonna do a very basic analysis. I'm just gonna come in here and just look at what's the volatility, and that's it. To be honest, I could come in here now and do add study, volatility range. Okay, good. And then I can do add study, volatility standard deviation. Good. And I'm gonna just put this in here. And I'm gonna put this in here. Here we go. So look, from a volatility point of view, if we look at USB, that guy is low. So options are cheap on USB. So it's a good beginning. Okay. Why am I calling this a good beginning? Well, it's a good beginning because the VIX was on the low side. So if I get into a stock that has low IV and the VIX is also low IV, that increases the chances. Just like the S&P going up increases the chances for the stock to go up. So if the VIX is low and the VIX is therefore likely going to go up, then that also increases the chances for the IV, the CIV of that stock to also go up. So that's pretty okay. Okay. The only thing I'm not too happy to see is the fact that USB is a $47 stock. So I would prefer a little bit more price. Would scanning for TSL plus one do this? TSL would give you more about the strength of the stock, but it will not give you about the strength of the sector. Okay, so I believe, Joe, your question is coming from that angle. Let me know if I got you right. If not, please rephrase it so I can follow you. So anyway, so we have USB with low IV, right? And if we look at and by the way, let me plot it. Continuous IV mean? Yes, I have it right. Great. So if we look at the implied volatility, which is currently trading at 28, compared to the 2 standard deviation of the of the historic volatility, we're also very low. So no matter how you will look at it, it seems that IV for that stock is quite low. So that's great because it meets our criteria. Okay. Now, 55-minute time frame, also great. We have 53% probability for those UFOs. So this is good. Okay, and we have a UFO there located at 47 to 46. So 46.72 is the black line, the EMA, which is inside that UFO. Okay, so we have a UFO lining up with the EMA in a proper climate condition with a proper level of volatility. The stock belongs to a group which is rotating. So everything is giving us permission to do the trade. Okay, so if we are going to do the trade, the question is, where is that thing going? So I'm going to click on this, and it seems that this target could be a valid candidate around 48 something, which lines up very well with that red UFO. So all of this is great, but I would say there is very little room to make a profit. We're going to lose some money on the bid-ask spread, and given the fact that this is a $40 stock only, we are going to profit in a way that is quite disappointing here. If we had a further target, I'd be inclined to plan on this trade, but I would say probably we're going to find better opportunities if we keep searching. Okay, and since we have a little bit more time, so I'm going to go for the second one on the list, which is Nike. Okay, so let's take a look at Nike and see what's happening. So Nike also provides with a setup that seems to be okay. So we are in a confirmed climate to the upside. Of course, the scanner, the matrix, give us that. Implied volatility is quite low. If we look at here, it's also looking very low. Okay, so implied volatilities are low. Now the only problem is that we need to wait for Nike to come back closer to the EMA to take the trade, and it's a bit far. Okay. The other problem as well is that probabilities for Nike are 47%, which means that the institutional interest is quite deceiving in that stock at this moment in time. We can look for other time frames, and probably we can fix it, especially with a 2-day time frame or something like that. Here we go. With a 2-day time frame, we would have what we want. Okay. And by the way, with a 2-day time frame, actually what we want looks very nice, because this UFO, which is a very large one, it's between 109 to 101, which is indeed overlapping and enveloping 107. Okay, so this is a valid setup. Okay, this is a valid setup. The only thing we need is the current price is 111 something. We need to wait for Nike to come back down this green UFO to get into the trade. Now, if we were to do that, the expectation for a target would be where? Let's take a look. It's right where we are. Okay, so the Elliott wave projections, if you wish, are showing a potential end of a wave at this price point, and therefore that speed bump is suggesting a significant turning point. So I'm not really happy to see that happen, unless what I would do here is wait for 1 candle, 2 candles, 3 candles to form, whatever, as Nike is going down. We may get, just like those black triangles, okay, we may get another one here, another black triangle here, and then from there we can then project the speed bump again. And now if we get a further target as we are coming towards the average, okay, now we have all this room for profit. That would be a beautiful trade. But as of now, market timing, we are in a place where Nike is more likely going to go down, at least for a few days before it pushes again to the upside. So I would suggest checking the next symbol on the list. Hopefully this is making sense. Okay, so matrix. Let me see. Joe, it was scanned within the sector as an added criteria. Yes, you could. You could. Not a bad idea, even though TSL is scanning in a different way. It's not looking for rotation. It's looking for the level of strength, 1, 2, 3, 4, right? So it's a different component. I was simply looking for rotation. So the next stock in the list is STT, okay, which provides 51% probabilities in the 55-minute time frame. Is in the right climate condition. Volatility for the options is correct. We got the line at 65, and at 65 we got a beautiful UFO. Okay, so this is a valid setup. We just need to wait for the stock to come here so the trade could be taken, but not yet. Okay, so let me take a look at the next one. Let me float matrix. So JD, we just close that trade on JD, isn't it? Okay, so this is JD. Yeah, not too happy. Probabilities are 42% only, but we are relatively close to the EMA. Let's take a look at the 2-day time frame. Even the 2-day time frame is 48%, so I'm not happy to see that. For non-directional trading is fine, but not for directional. We need 50% or above. Marvel is a $54 stock. Okay, let's forget about it. A bit too parabolic. Okay, it needs to come down closer to a reasonable price point. Nvidia, that's nice, $179 per share. Let's see what we can do there. Also quite parabolic as a move. Okay, quite parabolic as a move. 167 to 161. To be honest, these two UFOs together are lining up with the EMA perfectly. That would be a beautiful trade. We just need to wait for Nvidia to come down and do the trade. So similar situation. Netflix. Okay. So options on Netflix are not so low. Okay, so a directional butterfly would be the way to approach it. Okay, and we are in the right climate condition. And 197 is the EMA. And those UFOs are not located adequately. So let's take a look at the daily or the 2-day time frame. So yeah, so that UFO will be good. 199 to 188 in the daily time frame with 51.91%. The beauty is the potential for profit here is humongous. There is no UFO. If we break out and we go above this high, there is only an open gap above. So this is a beautiful, beautiful technical opportunity that would be nice to exploit. But we need the stock to come down to the green UFO to have a good entry point, which we don't have right now. So CMA. Okay, so here's CMA. So CMA has a valid UFO right here, okay, with 58% probabilities, which is good. Lining up with the EMA at 76, the UFO is 75 to 77. Climate is fine, volatility is low, so it's all good. Okay, all good. The only thing is that also in this case we need to wait for that stock to come to the UFO. So all the trades that we have assessed are valid. The only problem is that we need to wait for that market to come to us, which is obviously a problem because we cannot execute the trade now together in the session. So what is the alternative when that happens? Well, the alternative when that happens is to structure the trade differently. Okay, and we have done that before. So we could take the stock, for example, okay, and what we could do here is that we can get into selling 1 or 2 put spreads. Okay, we can sell 1 or 2 put spread, get some credit, and use this credit maybe to buy a call spread. Okay, so the one above is being paid by the one below. Okay, and what's the beauty? Well, the beauty is that if it goes, you start making money, and if it drops, it's really not so much of a concern because number one, the maximum risk is limited by the distance between those. But then coming down basically means that, okay, so instead of waiting and just doing nothing while you waited, so, you were just accumulating a little bit of time decay, and now, hopefully it's going your way, and if it's going against you, then you're going to get a limited risk. So that's a valid way to approach it, and then you have no time for waiting, okay? So now, CMA, I'm just a bit concerned about, yes, correct, that's it. So I was going to say liquidity, look at that. So the volume has been very few contracts. So that is a stock I would prefer to avoid. But the other ones that we have on the list could be valid candidates. You know what? I didn't check Lulu. I guess I missed it or something. So Lulu is also a valid candidate. 4 out of 8 actually is one of the healthiest from a climate point of view. And as it's breaking up from here, we are in that place, which is not recommended. It's very likely going to go down. Okay, so let's try to find a scenario where we are not in a place like this. What was Nike? I forgot. Oh yes, Nike was also in that situation. And Netflix. Yeah, so with Netflix, we went above this high. So there is a bit of room to keep going. So it's not necessarily going to fall immediately. Okay, so I would prefer to go for this one, 4 out of 6, and volatilities are not too bad. They're in the middle, so it's okay. So let's go for it. Let's take a look at Netflix and see if we can make something work. We said the EMA is 197, which was lining up, I believe, with a daily UFO. Yes, the UFO here located at 199, 188. Okay, so 199, let's call it 200. So I would like to rely on the 200 options. And if we're going to get into this trade, given the fact that the bet here is to fill in this gap, okay? So I would like to calculate how long it would take to get to 328. And that would be February next year. So if it moves at a normal pace, we're talking about February next year. That would be the pace. Okay, February next year. And the next earnings are happening when? In October. Okay, so yeah, so the maximum we're gonna give this trade is until October to get in trouble with earnings and have a major gap down against us. So let's take a look at October 18 in the option chain. Got 5 minutes. Let's see if we can do that. So October 21st. Here we go. So if we sell the 200 put, okay, we sell the 200 put and we buy the 195. So that's going to generate $500 of risk. And now I got 175. What can I buy with 175? No, this is not going to work. Not enough premium. I'm going to have to use too many units, and every time it's going to be $500 of risk per unit, so it's too much. Let me see what else I had here. I forgot the setup of JD. How was JD? We got 62. Did I look at the 2-day time frame? It was 48. The daily is better, but the UFOs are not lining up. Okay, yeah. So JD, I discarded it. What about Nike? Oh, yes, that's the one we said no. What about USB? USB, it's 46. And we had that there, right there. 4670 is in that UFO. Yeah, not gonna work because of what I said about the profit margin and the fact the stock is low price point. So yeah, it seems to me that in the end the best one is gonna be Nvidia. Okay, where we're gonna be relying on those UFOs there. Okay, so we broke out from this high, which is this one here. Okay, there is a little bit more room to go. So yeah, probably this is going to be the best. 167.5. Let's see, we have that on the option chain. And earnings are happening when? Right here, which is August 24. August 24. So we're going to be looking at August expiration dates with NVIDIA. I'm trying to move quickly so we finish on time. I got 1 minute left. Hopefully I'm not driving you crazy. I've done this before, so hopefully you guys are following. So 167, if I do this trade where I sell the 167 and I buy the 165, and I do it again, so it's 2 and 2. So that's a total credit of 145. With that, I could buy 215, which 215 is way beyond past my target. So that's not good. So the only way to approach it would be, let me get this cleared. So if I was to do like, for example, if I do 195, 2 of the 200 and 1 of the 205, that's 26. That's good. So if I was to widen it to make it 205, and we do a broken wing one to 215, 20. So that's a broken wing butterfly, which had debit of 63. Let's get a bit more wide. So if I do 210 and then I do 230, that's 163. That's pretty good. So look, if I look at this butterfly, okay, it's looking like that. So if the stock goes up, I'm gonna make money. Okay, with a target around 210, which is the ideal target. Okay, and this butterfly cost me 160. So if what I do is I sell 2 put spreads, okay, 167.5 and 165. So basically the cost of this trade is going to be $21 net. Okay, so if I want to make it a little bit for credit, I could get my option just a bit closer to 205, and that should do the trick. And now I got a credit of $100. So this is 2 put spreads paying for a call butterfly. Again, a bit more advanced than usual. This is the risk profile. If the stock stays anywhere between where it is now or falls a bit to where the UFOs are, it doesn't matter. I'm gonna be making $100 of profit on expiration on August. If it keeps falling, okay, my worst case scenario is to lose 894. How is the loss determined? Well, the loss is determined given the loss from the butterfly plus the loss from the 2 put spreads. Total is 894, which is the horizontal line here at 894. Now, if the stock goes higher, okay, I'm going to start making a profit, okay, which could be up to $1,000. Okay, so I'm giving myself a big room here for even if the stock goes against me, I'm still accumulating time decay and so on. And if the stock then goes, I'm going to make a greater profit. I'm not in love with the trade. And since on top of that, we have surpassed the time, I'm not going to execute it. But let me tell you why not. The reason why I'm not really in love with this trade is because it doesn't generate enough delta. And on top of that, I'm starting with a negative gamma, which means that the gamma is gonna become positive much later after we had accumulated more time decay. So this trade is gonna profit slow. If the stock happens to rally strong to the upside, this trade is gonna profit slow. And because of the market condition where the S&P is starting a brand new climate and the sector is rotating, we may have a big push to the upside, and then this trade will profit very little with a big push to the upside, which is very sad. So I'm not into it. And definitely I could work a bit more on readjusting this to make it work more, in a way that's more efficient. But since we don't have more time, I'm going to drop it here. In any case, new approach here, things that we haven't covered in sessions before, where I'm using two put spreads that we did before, typically to buy a call. But this time, what I'm doing is that I'm constructing directly from the beginning a butterfly. Okay. Yeah, of course it violates keys, Mark. This is options. I mean, can we keep it simple with options? Yes, of course. You can just come in here and be like, okay, so my target is right there, 185. So okay, you top, give me something that makes money if it gets to 185, and you turn on the strategy builder, and then you said, okay, look, maximum I want to raise 300. Let's see if we got something like that. Hide the losers, and here we go. Here are your trades. Okay, but in this particular scenario, in this particular case, the returns on investment are quite moderate. So that's keeping it simple. I was just trying to, squeeze more profit out of this trade. Of course, by going the route of adjusting, certain parameters and taking it to another level. But we know what's options trading. The beauty of options trading is that so many things could be done, right? It's amazing. But at the same time, we find when we get into this territory of building things that are very customized, we get into many exception scenarios where beyond trading rules and a trading plan, which we always need to have and respect and follow, we also need to use common sense on top of that. So the same application I did to NVIDIA, next thing you know, you do it to another stock, and given the current level of volatility or the current level of some price anomalies that we got on one strike or whatever, next thing you know, it works. So then you take it. Next thing you know, you do it to another stock, and the same application doesn't work. Again, that's options. Okay, when we do things that are complex, these things are to be expected, where sometimes some approach will work. Sometimes you need to have resources, which means like if I do, for example, like I done before with Twitter, if I do converting the double calendar to double diagonal and it worked, great. If it didn't work, I'm going to try the double butterfly. If it doesn't work, I'm going to try whatever. And you have a collection of what to do if something doesn't work to see if you can make it better. And therefore, you are following a set of rules, but you do it with common sense, knowing that with options trading, there are many times where certain application works with stock ABC, but doesn't work with stock XYZ, right? And this is something to be respected because obviously options is a complex asset, which when treated in an advanced manner. So we will see these non-keys approaches to trading options. Okay, so hopefully I'm opening your eyes for sure. I'm all about simplicity and everything else as well, but in my mind, and please correct me if I'm wrong, you guys are participating of these sections because you also want to take your knowledge and your skill to the next level, and therefore, little by little, I keep adding more and pushing you a little beyond, forward and outside your comfort zone. Hopefully, that's what you want. That's what you need. If that's not the case, please tell me. If you want me to focus on very simple options trades and stuff like that, I can also do that. Okay, let me know. Anyway, my friends, we're gonna say goodbye now. We surpassed the time by 7 minutes, so I'll say bye, and I will see you in the next one. Thank you for joining me today, as always. Keep up the good work, okay? And remember, we are around. If you need anything, do not be a stranger. Bye, everybody. Take care.